The Great Depression marked the most severe economic decline in contemporary history. In just a few years, individuals transitioned from enjoying parties, jazz tunes, and wealth during the vibrant 1920s to losing their life savings and queuing for bread. This crisis, however, was not confined to America alone. Its repercussions were felt globally and eventually contributed to the onset of World War II. But what were the underlying causes of the Depression? And what insights can we derive from it? Let's rewind to 1918. World War I has just concluded, and American soldiers are coming home, having emerged victorious. Ah, the joy of returning home. During the war, women had begun to enter the workforce in unprecedented numbers. With the return of men, the economy experienced a post-war surge. This economic upturn, coupled with a cultural shift, gave rise to the era known as the Roaring Twenties. In Detroit, Michigan, a man named Henry Ford was about to transform transportation with the introduction of the Ford Model T. With an overwhelming demand for the vehicle, his company pioneered the moving assembly line process. This innovation in mass production reduced the price of the car from $780 in 1910 to just $290 by 1924, making it the first affordable car for the general public. By 1927, the 15 millionth Model T would leave the factory. You get a car, you get a car, everyone gets a car. Numerous companies began to adopt this assembly line technique to mass-produce various inventions, including radios, washing machines, and vacuums. With the mass production of innovative products and enhanced advertising through radio, the consumerism era officially commenced. Everyone was eager for the latest and greatest products. To meet this demand, banks started to issue loans more liberally, allowing people to purchase these new items on credit with money they had yet to earn. Life was thriving, parties were in full swing, jazz music filled the air, and a sense of social freedom prevailed. Great to see you at the celebration, old sport. Prohibition began in 1920, yet it held little significance for the emerging generation. The parties grew larger, societal morals became more relaxed, and Wall Street emerged as the ultimate destination. Between 1921 and 1929, the U.S. stock market skyrocketed, increasing sixfold. Fueled by the post-war economic boom, accessible credit, and a surge in demand for new consumer goods, the public became increasingly aware of the astonishing returns from the stock market. This awareness led to a surge in investments and discussion surrounding it. Consequently, a snowball effect ensued. As the stock market continued its upward trajectory, individuals began to recklessly invest all their savings into stocks, with some even resorting to loans, which further inflated prices. When investors start to believe that no price is too steep for a stock, it serves as a cautionary indicator that the price may no longer reflect fundamental values and could be inflated to irrational heights. Despite stock prices reaching unprecedented levels, something felt amiss. By the mid-1920s, the economy and consumer demand had significantly slowed. With Europe still grappling with the repercussions of World War I and many nations unable to afford new consumer products, global trade was stagnating. Nevertheless, this did not dampen the overwhelming optimism among the populace, who anticipated that the stock market would continue to achieve record-breaking performances year after year. An atmosphere of extreme greed and unrealistic fantasies permeated the air. Thanks to margin trading, individuals could purchase stocks for just 40 to 10% of their actual price, planning to repay their loans once the stocks were sold at substantial profits. I would like to take out a loan. Sure, what for? A house, a business, a farm? To invest in stocks? No problem, here you go. By 1929, a staggering 40% of U.S. consumer debt was allocated to stock purchases. That same year, the U.S. welcomed a new president, Herbert Hoover, who famously proclaimed, We in America today are nearer to the final triumph over poverty than ever before in the history of any land. The poorhouse is vanishing from among us. For many individuals, a soaring stock market symbolized a thriving and prosperous economy. However, a grim reality was on the horizon. Disaster was imminent. On October 24, 1929, a date that would be forever remembered as Black Thursday, the stock market experienced massive liquidation, with an unprecedented 12.9 million shares traded, resulting in an 11% drop across the entire market. This day signified the onset of the Great Depression, and just a week later, Black Tuesday would follow, witnessing a 12% decline and a staggering 16.4 million shares sold. In just 2 weeks, stocks had plummeted by nearly a third of their value. Investors who had taken out loans to buy stocks were devastated, and countless individuals lost their entire life savings. Yet, the worst was still ahead. While it is commonly believed that the stock market crash was the catalyst for the Great Depression, this perspective is somewhat misleading. The stock market did initiate a recession, but the true root of the Great Depression lay in the fact that numerous banks had issued excessive bad loans and engaged in reckless speculation. During this period, many banks in the United States were small, independent institutions that lent a significant portion of their assets to individuals for stock market investments. As the market collapsed, these banks went bankrupt almost instantly. At that time, there was no deposit insurance, meaning that if a local bank failed, customers lost their funds. With reports of numerous banks closing, panic ensued, prompting people to withdraw their savings from even the most stable banks. This led to bank runs on otherwise sound institutions, which were forced to scramble to return all their customers' money at once. The situation escalated dramatically in New York City when a false rumor spread that the Bank of the United States had refused to sell a man's stock. This misinformation led to over 25,000 people flocking to the bank, resulting in $3 million being withdrawn by the end of the day. Anxiety filled the atmosphere, and fearing an unmanageable bank run, the Bank of the United States shut its doors and requested state intervention to take control of the bank's assets. Shortly thereafter, the bank was unable to secure a short-term loan to halt the bank run, ultimately leading to its permanent closure. It represented one-third of the total $550 million in deposits lost during the Depression. This event sent shockwaves throughout the banking sector, prompting many banks to call in loans and liquidate assets to maintain liquidity. One-third of American banks would ultimately fail during this period. Hey, Joe, I just sold my car, and now I have some cash to repay you. Which bank are you with again? Are you out of your mind? There's no way I'm leaving my money in any of those banks again. As people opted to keep their money outside of banks, the money supply in the U.S. plummeted by 31% from 1929 to 1933. Deflation wreaks havoc on an economy. By increasing the value of money, it diminishes consumers' willingness to spend, discourages investment, and heightens the burden on those in debt. All of this results in falling wages and income. Throughout this turmoil, the Federal Reserve remained passive, allowing the contraction of the money supply and the banking failures to unfold without intervention. This was a critical error that has faced widespread criticism for exacerbating the Depression beyond what was necessary. Amidst all this, U.S. President Herbert Hoover was at a loss for solutions and would bear much of the blame for the prolonged nature of the Depression. Following the initial stock market crash, there was a rising sentiment favoring isolationist and protectionist policies. In 1930, he enacted the Smoot-Hawley Tariff Act to shield U.S. farmers and other industries from foreign competition. This legislation raised tariffs on foreign imports to the U.S. by approximately 20%, which immediately provoked 25 countries to retaliate with their own tariffs on American goods. Consequently, global trade would plummet even further, declining by 66% worldwide from 1929 to 1934. Although global trade was a relatively minor component of the American economy at that time, this policy only exacerbated the situation. The Great Depression lasted over a decade, marking the most severe economic decline in modern history. The Dow Jones plummeted by 90% from its peak in 1929, leading to widespread job losses as companies closed their doors. A staggering 9 million savings accounts were wiped out. More than 9,000 banks in the U.S. collapsed. Industrial activity came to a standstill, and unemployment soared to 24.9%, the highest level ever recorded. To exacerbate the situation, a series of devastating dust storms swept through the central U.S., resulting in droughts and high winds that severely impacted agriculture, an event that became known as the Dust Bowl. This was the worst man-made ecological catastrophe in American history. As agricultural production dwindled and one-third of the American workforce remained in farming, the repercussions were dire. Homelessness and long lines for food became commonplace. In America, 34 million individuals found themselves without any source of income. Shantytowns sprang up across the nation, earning the moniker Hoovervilles after the disgraced president. Could the situation deteriorate further? In 1932, the U.S. elected Franklin D. Roosevelt, who vowed to implement significant reforms and take decisive action to lift the country out of the Depression. Through the New Deal initiative aimed at assisting those in need, he introduced a minimum wage, overtime compensation, unemployment insurance, and a Social Security system. Regarding banking reforms, he established federal deposit insurance to safeguard bank deposits and mitigate the risk of bank runs. Additionally, he created the Securities and Exchange Commission to enhance oversight and transparency for public companies. FDR's New Deal initiatives played a crucial role in stabilizing the banking sector and restoring public trust. Nevertheless, it would take several years for the U.S. economy to fully recover. As other nations also grappled with the effects of the Great Depression, this environment fostered the emergence of extremist regimes, and World War II would erupt just a few years later in 1939. It was not until the onset of World War II in 1939 that the Great Depression truly came to an end. At this point, the unemployment rate finally dipped below 10%, and the United States experienced significant stimulus to support its war efforts. Economists continue to debate the extent of intervention necessary to address an economic crisis, as well as the impact of the New Deal program. Many of the insights gained from the Great Depression remain relevant today, such as the importance of maintaining a modest, stable level of inflation to encourage consumer spending and business investment, a greater emphasis on government spending, and the necessity for government intervention to stimulate the economy during a recession. By reflecting on historical events, we can gain a clearer understanding of our current economic framework and identify any potentially hazardous trends that may arise in the future. Ultimately, it was greed that led individuals to believe that no price was too steep for a stock, prompting numerous banks to engage in risky lending practices. As with all economic bubbles, an excessively inflated market inevitably leads to the same conclusion: a painful crash. Please remember to subscribe, like, and share this video link.